Central banks just added thousands of tons of gold while retail investors are buying Bitcoin dips. That is not random, that is positioning. While social media debates, crypto volatility, sovereign institutions are quietly accumulating the oldest monetary asset in history. China increased gold reserves again. Emerging markets continue adding to their vaults. Poland accelerated purchases. The pattern is consistent. When instability rises, gold flows into central bank balance sheets, not into headlines, into vaults. Gold does not trend on social platforms. Gold does not promise exponential returns. Gold protects during systemic stress. That is why powerful institutions buy it when risk rises. Now look at the timing. Global debt levels are stretched. Interest rate cycles remain unstable. Currency tensions are rising. Geopolitical risk is expanding. In this environment, central banks are not chasing volatility. They are fortifying reserves. Retail investors often chase growth. Institutions prioritize survival. That difference matters. When a central bank buys gold, it signals something deeper. It signals concern about currency stability. It signals preparation for monetary stress. It signals diversification away from dependency. Gold is not yield generating, it is risk insulating. Why would institutions accumulate a non-yielding asset aggressively? Because yield matters less when systemic risk rises. Because stability becomes more valuable than growth. Because optionality becomes critical. Now consider Bitcoin. Bitcoin is volatile. Bitcoin thrives during liquidity expansion. Bitcoin struggles during liquidity contraction. Gold behaves differently. Gold strengthens during uncertainty. Gold attracts capital during fear. Central banks understand this distinction. Retail often does not. Retail sees gold as boring. Retail sees crypto as exciting. Institutions see gold as insurance. Institutions see crypto as allocation. Insurance and allocation serve different purposes. When stress increases, insurance demand rises. That is what central bank gold buying reflects. Preparation. Now ask a deeper question. Why are central banks increasing gold now? Because confidence in fiat systems is fragile. Because debt burdens are heavy. Because geopolitical fragmentation is accelerating. Because currency weaponization has become visible. When currencies are used as political tools, reserve diversification becomes strategic. Gold is neutral. Gold is not controlled by one government. Gold is universally recognized. That neutrality is powerful. Now compare that to retail positioning. Retail buys based on narrative cycles. Retail buys based on price momentum. Retail reacts to volatility. Central banks do not react emotionally. They analyze long-term stability. They assess structural fragility. They prepare quietly. If institutions responsible for monetary stability are accumulating gold, what does that signal? It signals concern. Concern does not appear in headlines first. It appears in balance sheets. Gold accumulation is a balance sheet move, not a tweet, not a speech, a reserve adjustment. Reserve adjustments are deliberate. Deliberate actions precede visible instability. Now think about historical cycles. Before major financial stress events, gold demand rises. Before currency pressure intensifies, gold reserves increase. Before confidence erodes, gold strengthens quietly. Retail notices gold only after price surges. Institutions accumulate before surge. That timing gap is structural advantage. Now look at the power dynamic. If central banks hold more gold, they increase monetary flexibility. They increase credibility. They increase protection against external pressure. Retail holding speculative assets does not gain that flexibility. Flexibility is power. Liquidity is power. Reserve diversification is power. This is not nostalgia for the gold standard. This is strategic positioning. In unstable cycles, hard assets regain relevance. Gold is the hardest of hard monetary assets. Bitcoin is digital scarcity. Gold is physical reserve anchor. Central banks trust physical reserve anchor during stress. That tells you something important. They prepare for scenarios retail does not anticipate. If systemic stress escalates, gold performs differently than high beta assets. If liquidity freezes, gold becomes collateral. If currencies weaken, gold strengthens relatively. This is structural behavior, not emotional behavior. Now consider this carefully. If central banks are accumulating gold while retail is concentrating in volatile assets, who is preparing for instability and who is betting on expansion? The difference determines survival during contraction. Gold buying is not loud. It is disciplined. It is steady. It is strategic. It is slow. Slow accumulation builds structural safety. Fast speculation builds structural fragility. Fragility breaks under stress. Safety absorbs stress. Gold accumulation does not create headlines immediately. It creates silent foundations. When central banks increase gold reserves, they are not speculating on short-term price movement. They are strengthening balance sheets. Balance sheet strength determines survival during monetary stress. Now look at what happens before major dislocations. Liquidity tightens, credit stress increases, confidence weakens. Volatile assets struggle first. Speculative capital retreats. During these phases, gold demand increases, not because it generates excitement, because it generates stability. Gold is collateral. Gold is reserve. Gold is credibility. When currencies fluctuate aggressively, gold anchors perception of value. Retail investors rarely think in these terms. Retail thinks in upside potential. Institutions think in downside protection. That difference changes positioning. When gold demand increases at the sovereign level, it reflects risk awareness at the highest layer of the financial system. Central banks have access to data retail never sees. They analyze currency exposure. They analyze trade vulnerability. They analyze debt sustainability. If they are accumulating gold while global volatility rises, it signals preparation. Preparation always precedes visible stress. Now compare gold accumulation to retail behavior. Retail often increases exposure during volatility dips. Retail buys high beta assets during uncertainty. Retail seeks opportunity in chaos. Sometimes that works. But during systemic contraction, high beta assets amplify downside. Gold absorbs it. This is why gold is often described as boring. It is boring during expansion. It is essential during contraction. Now think about liquidity cycles. When central banks tighten monetary policy, liquidity decreases. When liquidity decreases, speculative assets face pressure. Gold reacts differently. Gold often stabilizes or strengthens as real yields shift and risk perception changes. The relationship is not simplistic, but the pattern is consistent during systemic uncertainty. Central banks buying gold while retail chases volatility creates divergence. Divergence creates opportunity, but only for those positioned correctly. Now consider geopolitical fragmentation, trade tensions, sanction regimes, currency weaponization. Reserve assets become strategic tools. If a nation holds reserves primarily in foreign currency, it remains exposed to policy shifts beyond its control. Gold reduces that exposure. Gold is not dependent on foreign banking systems. Gold is not subject to counterparty risk in the same way. That makes it attractive during geopolitical tension. Retail rarely evaluates counterparty exposure. Retail evaluates price charts. That is a difference in scale of thinking. Scale determines resilience. Now imagine the next phase of instability. Currency volatility intensifies. Debt markets strain. Credit spreads widen. Risk assets decline. In that environment, gold becomes liquidity bridge. Institutions can deploy it, use it as collateral, use it as credibility. Retail holding concentrated volatile assets faces forced decisions. Sell at loss. Hold through stress. Liquidate under margin pressure. This is the structural trap. Protection assets rise quietly while speculation unwinds loudly. Gold accumulation by central banks is not about nostalgia. It is about anticipating fragility. Fragility in debt markets. Fragility in currency systems. Fragility in geopolitical alignment. When fragility increases, insurance demand increases. Insurance demand pushes gold accumulation. This is preparation for instability. Now think about narrative timing. Retail will notice gold when price surges dramatically. Media will highlight rally. Analysts will discuss breakout. By that time, sovereign reserves will already be larger. Positioning will already be complete. Retail often enters after confirmation. Institutions accumulate before confirmation. That timing gap transfers advantage. The same pattern exists across cycles. Early accumulation, late recognition, emotional entry, late exit. Now compare Bitcoin and gold under stress. Bitcoin thrives during liquidity expansion and risk appetite. Gold thrives during uncertainty and risk aversion. When central banks accumulate gold while retail concentrates in high volatility assets, it reveals risk prioritization difference. One side prepares for contraction. The other bets on continuation. Continuation is profitable until it is not. Preparation is expensive until it is necessary. When necessity arrives, preparation becomes power. Now ask yourself, honestly, if systemic stress accelerates, which asset class provides flexibility? Which asset class reduces vulnerability? Which asset class increases credibility? Central banks are answering that question with actions, not speeches. Actions matter more than narrative. If powerful monetary institutions are building gold reserves during volatility, it signals structural concern. Concern does not mean immediate collapse. Concern means awareness of fragility. Fragility is invisible during calm. It becomes visible during shock. The difference between surviving shock and being trapped by it is positioning. Positioning in protection versus positioning in speculation. Retail often equates excitement with opportunity. Institutions equate stability with power. Power accumulates quietly. Speculation fluctuates loudly. Right now, gold accumulation is quiet. Volatility in other assets is loud. Silence often signals preparation. Noise often signals reaction. The cycle repeats. Protection first, speculation later. When instability resolves, speculative assets recover, but those who survived without forced selling benefit most. Survival determines compounding. Central banks are positioning to survive systemic stress. Are retail investors doing the same? If this perspective sharpened your awareness of what is happening beneath price charts, stay close. Subscribe, because the next layer of this cycle will not be visible in headlines first. It will be visible in positioning, and positioning always reveals intent before outcome.